What if I told you the biggest players in American housing aren't winning anymore? For years, the story was simple. Wall Street buys homes, rents them back to families, and collects checks like clockwork. But now, the math is breaking, the politics is shifting, and in some corners of the market, the losses are already public. Today, we're breaking down why Wall Street just lost billions connected to housing, and the bigger question, what happens next for home prices, renters, and everyday investors? This is not financial advice, educational only. Segment 1, the real story. Housing is becoming a political asset class. Housing used to be a local issue. Schools, safety, commute time, the neighborhood you grew up in. But over the last decade, housing became something else, a national asset class, tradable, almost like tech stocks. And when something becomes tradable, it attracts leverage, it attracts institutions, and eventually it attracts politics. Right now, we're seeing both. On one side, there's a simple reality. America is short millions of homes. Goldman Sachs estimates restoring affordability would take roughly 3 to 4 million additional housing units. That's the size of a national supply problem, not a one-city problem. And on the other side, there's an emotional reality. Families feel like they're competing with cash-rich buyers. Whether that buyer is a hedge fund, a local investor, or a corporation, people see it as the same thing, someone with more money than them. So when affordability breaks, the next thing that breaks is trust. Segment 2, why Wall Street housing looked like a perfect machine until it didn't. To understand the losses, you have to understand the original pitch. Institutional housing strategies were built on a few assumptions. Americans will always need a place to live. Rents usually rise over time. Single-family homes feel safer than office buildings. You can scale it with professional systems, maintenance, leasing, renovations. And if you're big enough, you can borrow cheaper than everyone else. This turned housing into something Wall Street loves, predictable cash flow. But here's the problem. Housing isn't a pure spreadsheet business. It's a people business, a maintenance business, an insurance business, and a local politics business. And when interest rates, regulation, and operating costs change at the same time, that predictable machine starts to grind. Segment 3, the losses everyone can learn from when real estate gets too operational. Let's talk about a type of housing that exposed this risk in a very public way, senior housing. One major example reported in commercial real estate coverage, Blackstone's senior housing exit. The reporting describes a roughly $1.8 billion portfolio, around 90 properties and approximately 9,000 units, with over $600 million in losses and some sales at steep discounts tied to rising costs, pandemic pressure, floating rate debt, and operational complexity. And the lesson isn't senior housing is bad. The lesson is when real estate becomes extremely operational, leverage becomes dangerous, because housing demand doesn't automatically equal housing profits. If your labor costs spike, if occupancy drops, if regulators step in, if financing resets higher, your property can be full of residents and still bleed cash. Segment 4, the investor debate. Are institutions actually a big part of the market? Now here's where the conversation gets messy, because the numbers depend on definitions. Some research voices argue institutional investors are a small slice of total single-family homes. For example, AEI claims institutional investors own about 0.7% of all single-family homes and argues the bigger affordability driver is supply constraints and regulation, not institutions. But other data shows something else. Even if mega institutions are small nationally, investors overall, large and small, can be a huge share of transactions in certain periods. CNBC reported that investors bought 1/3 of all single-family residential properties sold in Q2 2025, and Redfin reported investors purchased 17% of U.S. homes sold in Q3 2025, noting investor activity pulled back in some areas while rising in others. So which is true? Both. Institutions may be a small share of total housing stock nationally, yet investors can still be a major share of the buyers competing for homes at the margin, especially in specific markets and price tiers. And in real estate, the margin sets the price. Segment 5, the quiet shift. Big landlords aren't buying like they used to. Here's something most people miss. The biggest landlords aren't always buying up everything. In fact, some are shifting strategies. CNBC noted that institutional investors have been selling more homes than they buy for 6 consecutive quarters, and named firms like Invitation Homes, Progress Residential, American Homes for Rent, and First Key Homes selling more than purchasing while diverting capital to build to rent communities. That matters because it changes what Wall Street in housing looks like. Instead of buying your neighbor's starter home, the strategy becomes own the entire neighborhood that gets built next. That's not a conspiracy, it's just capital efficiency. It's simpler to manage 200 homes built at once in one community with similar layouts, warranties, and centralized leasing. So if you're expecting a future where institutions disappear from housing, don't count on it. The smarter bet is they evolve. Segment 6, why the system is under pressure. 3 forces colliding. So why are losses showing up now? And why does it feel like the ground is shifting? 3 forces are colliding. Force number 1, the supply problem is still massive. Goldman Sachs points to zoning and land use regulation as a major constraint, height restrictions, limited buildable land, and slow construction productivity. Meaning, even if investor demand changes, supply is still tight in many job-rich areas. Force number 2, the transaction market changed. Higher rates and affordability stress slowed turnover. When transactions slow, the easy growth model gets harder, especially for strategies that rely on refinancing or constant acquisition. Force number 3, politics entered the chat. When housing becomes a national pain point, politicians look for visible targets. Corporate ownership becomes a symbol, even when it's not the only cause. And when regulation becomes a risk, Wall Street prices that in. Segment 7, what happens next? 3 scenarios. Now the part you actually care about, what happens next? I see 3 realistic scenarios. Scenario A, the policy clampdown era. If federal or state policies restrict how large investors buy or hold single-family homes, institutions may slow acquisitions further or shift even harder into build-to-rent and multifamily. AEI argues policies targeting investors could reduce renovation and new rental supply and could even push rents higher in some cases if supply shrinks. Translation, policy can reshape who owns homes, but it doesn't magically create more homes. Scenario B, the slow bleed era. Higher costs, lower growth. This is where big landlords remain, but returns normalize. More selling, fewer bidding wars, tighter underwriting. CNBC's reporting suggests some big landlords already look like net sellers, not net buyers, while still staying in the space. Scenario C, the new construction capture era. Institutions and large operators partner with builders. They fund development, then acquire entire blocks of new homes. This could increase rental supply, but it also changes the American landscape. More people renting single-family homes long-term, and fewer mum-and-pop owners in certain submarkets. Segment 8, what this means for you, home buyers, renters, small investors. Let's get practical. If you're a home buyer, if large buyers are selling more and bidding less in your region, you may see less competition, especially for homes that used to be perfect rentals. Your advantage isn't cash. Your advantage is flexibility. You can buy a home that needs cosmetic work. You can buy a weird layout. You can buy a property that doesn't fit a corporate box. Look for listings sitting longer than average days on market in your zip code. Target homes with minor cosmetic issues, paint, landscaping, flooring. Ask your agent for previously rented properties. Some landlords offload those. If you're a renter, more build-to-rent can mean more professionally managed options. But if policy or supply constraints reduce rental inventory, rents can tighten. Remember, supply drives rent. Goldman's analysis emphasizes how land use constraints limit new supply. Negotiate renewals, especially if new supply opened nearby. Ask for concessions, free month parking or reduced fees. Compare not just rent, but total monthly cost, including utilities, fees, and insurance add-ons. If you're a small investor, this moment can be opportunity if you act like a business and not a gambler. CNBC notes, small investors account for more than 90% of the investor market, defined as individuals owning 10 properties or less. Don't underwrite hope, underwrite cash flow. Stress test, vacancy, repairs, taxes, insurance. Focus on stable demand drivers, hospitals, universities, major employers. Segment 9, the big truth. You can't ban your way out of a supply shortage. Here's the line nobody wants to say out loud. Even if you removed every institutional buyer tomorrow, America would still have an affordability crisis because the country is still short millions of homes. Goldman Sachs puts the fix at roughly 3 to 4 million additional units and highlights zoning and land use restrictions as key constraints. That means the long-term solution is boring but real. Build more homes, allow more density where jobs are, reduce friction in construction, and make it financially possible to produce entry-level housing again. Everything else is a headline. So Wall Street lost billions connected to housing, and in some cases the losses weren't because people stopped needing homes. The losses came from the collision of debt costs, operating complexity, regulation risk, and changing market conditions, the exact things spreadsheets underestimate. And now the playbook is being rewritten. If you're a buyer, your edge is patience and flexibility. If you're a renter, your edge is options and negotiation. If you're an investor, your edge is discipline, real underwriting, not vibes. Final note, this video is educational, not financial advice. Real estate is local. Always verify numbers for your market. If you want, comment your city and whether you're a buyer, renter, or investor. I'll suggest what metrics you should track weekly in your area.